Hey, good morning, everyone.
Good morning, Professor.
Hey, good morning, Angelica. Good morning, everybody else. Uh, there are 12 people, right, in the Collaborate. And, right, good morning, Maricel. Just before I joined the Collaborate session, I checked. When I looked into the discussion board, there were 11 people. Let me just make sure if I have everyone uh, in there. Everyone here is also in the collaborate session. Okay, so you all. Let me just go to. Okay, there are 12. There are 12 people in the. And there are also 12 people here. So everyone in the collaborate session is also in the um, discussion board, and that's very important because you nobody wants to invalidate their attendance, right? All righty. So we are, and one more person has just joined, and so it's like Jody Ann just joined us. Jody Ann, don't forget to sign in on the discussion board, right? I just mentioned, the um, importance of what the validating your attendance, right? By signing into the discussion board. All right. So the first quiz is over. Okay, good, Jodian. Good, good. I couldn't check. I'm going to uh, within today. I'm going to post the summary statistics of that. And um, well, the fact that we have finished first quiz means that we are done with the second topic, right? The financial statements, right? Although by collaborate we are still on it, but everybody must understand that we go by the main lecture, and the main lecture by main lecture we already here, right? Today's topics are Euler's numbers. And this is, if you have been following, of course, we are going to review this later because we're just, collaborate session is just, delayed or behind the main lecture because it's meant to be uh, a review and reflection. So we're going to eventually get to that. And the good thing is, in time value of money is all about compounding, right? Compounding and discounting. And we talked a lot about compounding already. We know already something about the basics about the compounding. Um, we know that from the first topic, right? As we did, house value house value example. So the single cash flow model, right? Future value, present value of the single cash flow model, isn't that difficult thing? Uh, and also you learn geometric average, right? So that's basically part of the single cash flow model. But Euler's model, we didn't talk about, uh, but then how to solve for n, and that's what this Euler's number. That's where the Euler's number comes in. You need to understand the Euler's number and natural log uh, to be able to fully understand uh, the how to solve for n, right? The formula for solving for n. So that's today's, main lecture. And although, a little bit behind, we'll be catching up on, we'll be, catching up with this in the collaborate, right? Sooner or later. But today, we need to continue. We need to continue with the this financial statements, because in the last class we came to what operating income is. Because finally, think about it. We identified all the sources of income, and we identified all the sources of expenses. Of course, there are two primary sources of income and two primary sources of expenses. I mean, a primary source of income is sales revenue, of course. Secondary source of income is passive income, such as investment income, right? Now, primary source of expense is CGS, cost of goods sold, and then operating expenses. Also, that's also a primary source. It's not relatively significant because they are like two legs or two columns, right? That support that support the ceiling, or the that support the roof. Two columns. So as I said last time, so we need to subtract all the expenses or cost from the revenue or income. And revenue minus cost is roughly, it's profit generally. They call it profit, but it's just, it's not exact term. I mean, roughly it is profit, but the correct term is operating profit. Operating profit. Okay. It's called operating income or operating profit. And it goes by at least three different names, but they all mean the same thing. One, it goes by operating profit. That pi stands for profit. And some people may say, wasn't that inflation? Yes, pi stands for inflation in macroeconomic context, but it stands for profit in microeconomics context, because pi stands for, pi is Greek character for P, Roman alphabet P. And what would P stand for? Profit. Okay. So operating profit, the name is operating profit or operating income, or EBIT. EBIT stands for earnings before interest and taxes. Earnings before interest and taxes. Now, the name EBIT is, I like this name. I like the way they named it. I like the way they named it because it's quite self-explanatory and quite predicting. Right? Because the name is earnings before interest and taxes. Then it's easy to tell what happens next. What should happen next? It already tells what should happen next. Excuse me a second. Now, because the name is earnings before interest and taxes, then what should happen next is paying interest, right? From the name, and this is surprising. Whenever I teach this class and when we are here, although the name is so predicting, self-explanatory and self-predicting, When I ask this question, very few people get it. Very few people answer it correctly. Think about it. It's EBIT. So it's earnings before interest and taxes. Then what should come next must be paying interest, right? And then paying taxes, right? So since the name is already self-explanatory, that's something quite that's the merit. That's the merit of this name, rather than operating profit or operating. But operating profit is good because think about it. The reason it is called operating profit is because it's revenue minus cost, right? Income minus expenses. Yeah, roughly. I told you it's called operating profit. You cannot just call it profit, right? You cannot call it just profit because that's um, inexact. It's not exact to call it just profit. It's more exact to call it operating profit. And it's also called operating income, but I don't like that name, right? That terminology. Why? Income is gross state. This is income. So from income, you subtracted expenses, then it shouldn't be called income anymore, right? It should be still calling this income is, although it's operating income, but income, if you continue to call it income, um, it's like you have now it should be net, right? From gross income, right? You subtract it. So shouldn't we call it net income? No, no. Net income is actually here. Again, repeating the term income, that's what accounting does. And I don't like what accounting, I mean, there's no distinction, as if they continue to call income. But, there's a reason for that. I mean, for that, uh, although I said I don't like accounting, I still give some credit to what accounting uh, did in terms of terminology. Um, but uh, the reason, the income, the terminology income is still maintained here is because of the personal finance case. I mean, if this individuals, people, just a natural person, right? Being a natural person doesn't keep income statement or balance sheet. But of course, it's because income statement and balance sheet are what um, uh, businesses need to maintain, keep and maintain. But there's no law against a person keeping track of his income statement, right? But it's just not it just doesn't have any business sense to it, right? I mean, it's not used for. If you are operating a business, if you are running a business, then income statement is a must, right? But for a person, for an individual, uh, it's it's an option you can do, and but then it's just for your own sake. It cannot be used for tax purpose, right? I mean, it can help you to correctly calculate your taxes, but you don't like submit it as part of the requirement. But if you keep this, like if you're self-employed, you can keep your own income statement. You can keep track of your expenses, income and expenses. I mean, it's basically, keeping track of income and expenses and subtracting, expenses from your income. But in that case, if it is a personal income statement, calling it profit is operating profit is a bit weird, right? In case of personal income statement, calling it income is still the right way to call it. So, as I said, for a business, calling it operating profit is a better way. But for a personal income statement, calling it operating income, net income, those are, the right way to call it. But anyway, because this is called operating profit, that means that's the result of the operating activity. Yes, what is all businesses, operating activity is basically selling something, and think about it. All businesses basically have to sell something, right? That's primary source of their income, sales revenue. So operating activity of the business is basically selling something, right? Merchandise, be it physical or services, right? Non-tangible or services, right? They sell something and they must subtract expenses. That's called operating activity. So operating activity is basically, I think I put a, didn't I? Yeah, I didn't. So basically, every step, right? Every step from here all the way down to, oh, come on. All the way down to this point is operating activity. Operating activity. In other words, arriving at operating income or operating profit or EBIT, that's operating activity. And all businesses are engaged in three types of activities. Three types. Operating activity, of course, and then investing activity and financing activity. All these three. And income statement is basically the description of the operating activity, whereas the balance sheet is the description of the investing activity and financing activity. Okay, so we're going to get to the balance sheet shortly, but before that, so we can tell, that earnings, because earnings, EBIT, right? Earnings before interest and taxes is the same thing as operating income, operating profit, right? So you can say that the earnings and profit mean the same thing. Earnings and profit mean the same thing, right? Earnings and profit are basically the same thing, right? But the term earnings is specific to accounting only, because in finance, earnings per share, the term is, still used, but in economics, they don't use the term earnings. In economics, is profit, right? In economics, is profit. But earnings is not the same thing as income, right? Earnings is not the same thing as income. Income is, gross concept, gross income. Now, So we must, from EBIT, we must subtract interest. And we have interest because we have debt, right? This is the interest payment, right? This is not interest income, right? If it is interest income, then it will have to be captured here, right? It's not the interest that we receive for holding bonds. It's the interest we pay because either we sold bonds or we have a debt, right? We have a debt loan from the bank, and it's an obligation. So it depends on, oh, okay. So it depends on the amount of debt, long-term debt that we have, and that comes from the balance sheet, right? Long-term liability side of the balance sheet. Here's a long-term liability, and see how they are connected. So our interest, if it is, our interest rate is 2.5%. You might wonder where that 0.63 come from. Annually, all the rates are basically annual, right? Annual. So our interest rate is 2.5%, and I multiplied it. I divided by 4 because what did I say? Our statements are basically quarterly, right? All the statements, the basic cycle or basic operating period is quarterly, right? I have to divide it by 4. Therefore, and then you see F5 times L27. So without the this data in the balance sheet, F25. Was it F25? Yeah. F5. And F5, oh, we have interest payment here. So L20, this is already L27. Okay, so it looks like I have assumed I should make it quarterly. Okay, divided by 4. Okay, F12 times L20. F12 is this, L27. Oh, L27 is already quarterly. I'm sorry. It was already adjusted. Right? So the interest payment here, then I shouldn't even do this. There's something I messed up. I need to simply point to F5. I mean F5 only, because that was already quarterly interest. Okay, so I messed it up there. Yeah. So this number and this number must be the same. F5. They must match, right? So, and it's because we have this, debt, right? Long-term debt, right? And then our long-term debt is mainly bonds and mortgage. Payable, that's wrong. Payable. bonds payable, right? And of course, the interest rate on both cannot be the same thing. I mean, bonds, when we issued bonds, right? The coupon rate on the bond, there is no guarantee that the coupon rate on the bond would be the same thing as the mortgage interest rate on the mortgage we got, right? And why did we get the mortgage loan? Because we needed that to for our fixed assets, especially building and land, to acquire building and land. And it looks like the amounts match, right? In other words, we have $3.5 million in building and land, and that was entirely financed entirely by the mortgage loan. Okay, and of course we don't have again, the interest rate on the mortgage loan and the bonds do not necessarily are not necessarily the same thing, but we have to I just used the assumption. I just used the assumption that the interest rate is 2.5%, right? I mean, I took a kind of weighted average, right? I assumed weighted average of the interest rates, right, on both. So that explains why interest is like this. Then from EBIT, interest is gone, right? From EBIT, interest is gone. Then, so the from EBIT, right, I should drop out. If I drops out, then it becomes EBT. And it is literally, earnings before taxes. Now we have earnings before taxes. And we have actually, this one is, I deliberately, it's actually, this. So you subtract this from this. Our EBIT was already negative, and if you subtract interest, it's going to be more negative, right? It's going to be more negative. But then, is there? I wouldn't put it here. I wouldn't put it here because there can be no negative taxable income, right? I mean, if the taxable income is negative, what does that mean? The taxes will be negative. I can. All right, fine. Let's I can do it. I can put it. Basically, I can do it here. I can put it there. Taxable income can be negative, but that means taxes are not negative. If although taxable income can be negative, taxes cannot be negative. Think about it. We have, this means we have loss, right? We have loss this quarter, right? We have loss, a huge loss, $153,000, a huge loss. Right. And think about it. If we have loss, then we have no taxes to pay. I mean, we cannot pay taxes. If we have profit, then we pay taxes. In other words, if we have positive EBT, so EBT, earnings before taxes, another name for that is taxable income. If we have positive taxable income, then we pay taxes. If you have negative taxable income, the taxes will be zero. We don't. In other words, and I used if command here. Okay, meaning if I don't do it, right? And people just mathematically just oh, that's 35%, tax rate is 35%, so I'll multiply this by 35. This is a mindless thing, you know? Okay? It's a stupid thing, foolish thing, and mindless thing. Why? To the negative taxable income, if you multiply tax rate, you will get just mathematically negative number. So the taxes are negative. That means you're saying taxes are negative. But use your common sense. Use your good sense. Huh? If you have a good sense, then you can easily tell. If you don't have any taxable income, right? Then you don't pay any taxes. So this cannot be, right? In other words, what is the meaning of negative tax? I mean, does that mean, the government owes me money? Huh? I mean, think about it. Negative tax means, normally tax is what you pay, right? What you owe and what you have to pay. But if the tax is negative, then the other party owes me, right? Does that mean, so I do a bad business, I mess up my business, so I ended up in loss, then the government should, pay me tax? Government, IRS owes me tax? No, that's obviously nonsense, isn't it right? So people who just, without thinking, just mindlessly, just do this mechanically and multiply negative taxable income by tax rate and put this number there is just, doing, mindless thing. And they think, oh, it's because it's Excel, it must be correct. No, you don't. Excel only executes the command you put into it, right? It only executes, right? It's like, so Excel is only as good as your command, right? If you issue a bad command, a bad result. It's just like, you are the commander, you are the general, and there are soldiers in the field, and they are reporting to you that there are like 100 people in the 100 people. We can detect, a heat signature of 100 people, but the scouts reported that there's a good chance those are civilians, not the enemy combatants, right? There's a good chance. And there's this report, but you just blindly issue an order. Oh, if there's a heat signature, just kill them off. But you don't know. I mean, the scouts have reported there's a good chance that those could be civilians, not the right. General orders his soldiers to fire, but it could be civilians, then civilian casualty. It would be a disaster, right? So it's just like that. Your Excel only executes your model, your command, right? And if your command is senseless, there will be a senseless result, right? There will be a senseless killing. So you must use your good sense. You can't have this result, right? And you understand, because in the when we talked about real interest rate, nominal interest rate, and real interest rate, inflation, and what negative real interest rate means. You also know what negative nominal interest rate means. If the interest rate is negative, that means lender doesn't get interest, right? It's like lender loses interest, right? lender is like paying interest to the borrower. So if you have negative number here for taxes, then it's the same thing. It's like, so I use this command, right? If this cell is greater than 0, in other words, only if this cell, the taxable income, is positive, then we multiply that by the tax rate, right? Otherwise, just put 0 because there's no taxes to pay, right? There's no tax to pay. So Excel automatically picked 0. This is the sensible thing to do, right? Instead of just blindly following, oh, this is taxable income, then I must multiply that by tax rate. That's a senseless thing, right? So then finally, we arrive at the net profit or earnings after taxes, because from this you pay taxes, so now you're that's on earnings after taxes, right? Net profit or EAT. There you go. And then, of course, then from our net profit is then from our operating profit, right, minus sum of these two. Of course, it will still be negative, right, because it cannot be positive, right? Our operating profit was already negative, right? So we arrive at this, net profit. Okay. Now, so we are done with the income statement. Then we'll be moving on to the balance sheet, right? We'll be moving on to the balance sheet. Now, any questions so far? Any questions? Anyone? Any questions so far?
No questions so far.
All right, good. All righty, Angelica, I think it's quite clear, right? Now, so now balance sheet, right? And I told you income statement they both serve different purposes. The income statement, the purpose of income statement is to describe the process leading to profit or loss. But the balance sheet, the purpose of balance sheet is to describe the capital structure. Capital structure. What does that mean? What's the capital structure? Capital structure is simply, the ratio of debt and equity, right? Debt and equity. In other words, how much of the total assets come from debt, and how much of the total assets come from equity? Okay. So some accounting people might say, that's only very limited because that's only the this liabilities and equity side. But what about assets? Of course, balance sheet also describes the composition of all assets. But basically, assets come from liabilities and equity, right? So composition of assets, no matter what the composition of assets looks like, right? What's important is the composition of debt and equity, right? And then the size of the debt and equity determines the size of the total assets, because the reason it's called balance sheet is because assets is equal to liabilities plus equity. In other words, liabilities and equity, size of the liabilities and equity determines the size of the assets. And because they must be balanced out, that's why it's called balance sheet. Think about it. You cannot, if the total size of the liabilities and equity is $10 million, then your asset size cannot exceed 10 million, right? And then liabilities, the reason we are first focusing on the liabilities and equity is because that's the source of capital. That's the source of all the assets, right? So let's assume a computer manufacturing business, a company like Dell, and assume at the startup stage, right? At the startup, this company is just starting off. So someone like Michael Dell, of course, all these, back in the 1970s, the Microsoft and Apple started out in '76, and in '76, Bill Gates and Steve Jobs, they just, manually hand built the computers in their father's garage, okay, or in the basement of their father's house, right? So that's a startup. Started to sell it through like Best Buy or in the PC Richards, or in those days. Um, but think about it, but it should be mass produced, not just hand built. I mean, there's a limitations, Michael Dell also started a little later. I think Michael Dell started in late 80s. They all started from like their father's garage, right? Um, because they are a startup. They don't have they cannot have mass production, and because they don't have capital. So what do they do? I mean, they need to. The business needed to grow. They needed more capital. So what would they do? Um, they will go to the bank, but will they get a loan? No, they will get rejected, right? They get rejected because why? A startup is nothing but a brilliant idea, right? A business model based on some brilliant idea only. So there's nothing, no track record, nothing to put up as collateral. So with nothing to put up as collateral and no track record, uh, the banks will, automatically reject. You might say, "Oh, can't they sell stocks, and bonds?" No way. This is a startup. You are not a startup. You cannot get listed in the stock exchange or bond exchange. You can't get listed there. You haven't met. I mean, you have to meet. It's like an elementary school kid um, without any SAT score or without any proven track record comes to Harvard University or Yale University, MIT, telling them, "Let me in," right? Let me be a student here. Just crying out, "I'm a genius." But look, if you're a genius, bring us a proven record. If you're a genius, and if you're, but again, if you're really it's a different story. I mean, if you want to go to MIT or Harvard, Princeton, claiming that you're genius, yeah, you can take IQ test and prove, I have 180 IQ, and also take SAT. I have like one. I have 1800, or I have 200 2,400 points score, 2,400 on SAT. That can be proven. There's a proven track record, right? But in business, right, there's no proven track record, and there's no uh, so you don't meet the requirement, right, to be listed in the stock market. So there's no, you cannot sell stocks, you cannot sell bonds. So the only way um, you can raise capital is, to get by getting a loan from the bank, but bank will reject you. That is the like most. That is the likeliest case scenario. That's the likeliest scenario. Um, but in reality, most of the startups, if they really have a great business model and really reliable technology, right? And who can determine that? The bankers cannot determine that. So those who can determine that are the people who are also scientists and engineers themselves, right? And there are people who work for venture capital. There are scientists and engineers who work for venture capital, and they and the venture capital are specializing in these, startups that have, great potential. So you can go to these conferences for venture capital, and if you get proposal, trade, there are trade fairs, that's where you can meet the venture capital. Venture capital will also, you guys, if you guys ever watched a TV show called, Shark Tank. Shark Tank is about what? They're trying to find entrepreneurs, right, who have business model and technology, and who need funding, right? So it's in a way matching the uh, funders, right, or venture capital uh, with the startups, right? And the same thing with, venture trade fairs, trade fairs, conventions, from those conventions, if you are spotted by the venture capitals, then you get funded. So that's the reality. But let's say, just hypothetically, they were able to find, they were able to get find, venture capital, and able to borrow money from the bank, and they were able to sell bonds, right? Uh, just hypothetically, right? They were able to raise, through stocks and bonds, right? Um, about $10 million. Why do they need $10 million? First, think about it. This is manufacturing, and all manufacturings basically require plant and equipment. Isn't it right? There is no manufacturing without plant and equipment. So, plant and equipment, land and building and land, that cost already, that alone cost almost, about $10 million. I mean, without depreciation, forget about depreciation, because depreciation is at the end of the year, right? Only at the end of the operating period. So at the beginning, at time zero, there's no depreciation. That's almost, $10 million. Now, think about it. That's the sunk cost, isn't that right? We talked about the I talked about the sunk cost, right, which is the initial investment. Now, manufacturing requires initial investment. You must have plant and equipment. You must have, building and land. So you need, this company needs, $10 million. And how do you raise $10 million? Through equity and debt. That's the only way. And you are able to find a venture capital. So you raised, $4 million through the venture capital. Venture capital would be your major shareholder, right? Because they are equity came all from um, the venture capital, so they are your major shareholder. And then you raised about, also you raised about $6 million in debt, right? So your $10 million total assets came from $10 million debt and equity, right? To be, which, which is comprised of 4 million equity and 6 million debt. Okay, so that's why it's called, balance sheet. And the balance sheet shows, the composition of debt and equity that makes the assets, right? And the composition of debt and equity is called capital structure. It's called capital structure. And we need to define what asset is. Of course, asset is defined by mathematical definition. Asset is equal to liabilities and equity, right? Debt plus equity, right? That's mathematical definition. The verbal definition of debt, verbal definition of asset, assets must have income generating capability. Assets are something that generates income. So it's like, definition of capital. Remember, capital means, means of production, right? Something that produces something. But, asset is more like, the profit side. I mean, more like, something that generates income, something that has income generating capability, income generating power. So when we say capital in economics, it's means of production. That's the physical side of it, right? Means of production. So then, if it is a means of production, then that's the output, right? Output. So outputs are physical products, right? Physical. I mean, it could be non-tangible, right? Non-physical, non-tangible, but uh, real side of the output. Whereas asset means, it's more like monetary side of the uh, of that, definition of capital, because assets must generate income. Assets have income generating capability, income, which is, the monetary side of output, right? All right. So that's the briefly, that's the definition of, income. And the plant and equipment, land and building, is called fixed assets, or real assets, or physical assets, or long-term assets, or non-current assets. Goes by different other names, but one thing is quite clear: these are physical assets or real assets, right? Um, and the assets divide into current assets and non-current assets. And if the non-current assets are physical, real, long-term, that means, current assets are non-physical, so liquid, and short-term, right? Okay, so it is 11:59 right now, so it's right time. It's the right time to take a 10-minute break. Okay, so let's take a 10-minute break, and we'll reconvene at exactly 12:10. Okay, let's reconvene at 12:10. All right. All right, we're back. We're back. So, um, so in the first, it's quite obvious that the liabilities and equity side, right? Liabilities and equity side, uh, how it is, um, what it's comprised of, right? Uh, it's basically equity and total debt, right? And then total debt breaks down into non-current liabilities and current liabilities, right? So it looks like equity is just one line item because it's just total amount of equity, right? Uh, Total book value of the stocks sold, right? Um, so it looks like it's almost liabilities. Liabilities are a big part. No, in our model, uh, it's a dollar amount, and the liabilities are almost 6 million. Equity is 4 million. So it looks like debt is greater. Of course, only in this example, this is typical. But this is a risky company. I mean, if you think about it, if the capital structure is like 60% debt and 40% equity, um, uh, this is this type of capital structure is clearly indicative of uh, big financial distress, right? Because everything you earn will be consumed, right? Everything you earn will be consumed in paying the interest and principal, right? And hardly anything left for um, the shareholders, right? Um, and so it's under heavy financial distress. And besides, this company uh, had even negative profit. I mean, it's like they already this is already like a house crumbling, right? Uh, it's not a sound capital structure. Uh, so you might think equity is just one because it's just one line item, and most of it is liabilities. You might think liabilities is a bigger part. No, it's just broken down into um, more details. Equity doesn't need to be, I mean, equity doesn't need to be broken down into more detail because equity is basically paid in capital. It's capital that was paid in at IPO when they sold stocks for the first time. Um, so the equity, it cannot be broken down further. It's just one single line item. But just because there are more line items in the debt, it doesn't mean debt is more important in uh, the balance sheet, right? No, and mostly it would it would be the other way around. I mean, most of the times the capital structure would be like 60% equity, 40% debt, or 70% equity, 30% debt. I mean, even having 60-40 capital structure, it's already uh, pushing uh, the limit. It's already pushing the limit of the uh, default, right? Uh, if the capital structure is like more skewed to debt, then 60%, 40%, 60% equity, 40% debt, then this company is, already in very heavy financial distress, right? That's like the envelope, and pushing it more. If it is 50-50 or 55 to 45 equity debt, that's already very, it raises the red flag already from 60% equity, 40% debt. The red flag is already raised. But but anyway, in this example, it just happens to have way smaller equity than liabilities. But let's take a look at the asset side. We already understand. So the long term, think about it. Everything, long term debt, long term assets, they are easy to understand, right? Where did the long term debt come from? Either from paying from the bonds, by selling bonds, or by getting a loan from the bank. And then they would be used for plant and equipment, building and land. Of course, in this example, mortgage alone was only for building and land, right? I mean, the numbers tell us already, where that 3.5 million for building and land came from. It came from mortgage, right? Now, plant and equipment, I already talked about it, is crucial to manufacturing. And there can be no manufacturing without plant and equipment. It goes without saying. And then take a look at the current assets. Current, these are also called short-term assets, but if you think about it, they are all liquid assets, as opposed to the physical assets or real assets, right? And liquidity, right? We talked about liquidity when we, in ROI, liquidity, there was a liquidity risk premium, right? Liquidity is basically how easily you can turn any asset into cash. So if you look at the these line items, they are in the order of liquidity. First of all, cash and cash equivalents are, cash is already cash. Cash equivalents are almost like cash. They are like very short-term debt instrument, very short-term, like very short-term commercial paper, traveler's check. I have examples of. I have a link for that, right? In the second topic, topic 2 folder, right? What are cash equivalents? Cash equivalent, short-term modest return, low risk, right? And don't change in value frequently as stocks. You can click on it and see what cash equivalents, examples of what, are the examples of cash equivalents, right? And if you can hear this audio.
Cash and cash equivalents are items on a company's balance sheet that are either physical currency or liquid investment.
You can hear it.
Can be immediately.
Okay, good. I'm not going to play that because you can always you can always read it and you can always play that later. And marketable securities mean stocks and bonds, right? And stocks and bonds can easily turn into cash, right? Promissory notes, I believe I talked about this. Promissory in B2B, business to business, right? Promissory notes are very frequently used because uh, in B2B, like between Best Buy and Dell, right? Between Best Buy and Dell, let's say Best Buy is buying 1,000 of Dell's Model X computer, Model X, and Model X is $300 each. That's the X factory price. In other words, that's the price that leaves the factory of Dell. That means Dell sells it for $300 per unit to Best Buy. Of course, when Best Buy gets it, uh, they will charge, right? They will sell it for something greater than 300, of course, because 300 is for them their unit cost. So they cannot sell it for 300. They will have to mark it up, right? Markup by they can mark up by 100 or 200. So let's say they sell it for so Best Buy selling price will be something like 500. Okay. So if they buy 1,000 units from Dell, they have so total will be $300,000, and they have four modalities, payment modalities, right? Four payment modalities. One is cash, of course. Two, they can pay by check. Three, credit cards. Four, promissory notes, right? Promissory notes. But from Best Buy, the buyer's perspective, right? The most preferred payment modality is promissory note. Why? Because it can buy them most time. It can buy them most time. Meaning, if they pay with cash, the cash will leave their hand instantaneously, right? Cash will leave their hands instantaneously. If they pay with, check, it won't take more than 3 days to 1 week to clear that check, right? It's called, float, right? The time between the time for the check to clear, right? Until the check clears, this $300,000 will appear in Best Buy's bank account, as well as it appears also in Dell's bank account. Of course, until it clears, it will say pending, right? But this period until the check clears is called the float. The check is in float. But it won't take more than 3 days to a maximum of 1 week. Okay, most likely it will take 3 days, these days. So in 3 days, it will leave, the hands of the buyer. And then third, a credit card, it's 1 month, right? Credit card payment is, you have a leeway of 1 month. But using the promissory note, theoretically, it can be up to 360 days. Of course, no one accepts, no seller accepts, promissory notes, with maturity longer than 60 days. In general, the maximum would be about 60 days. That's like 2 months. So what does this, 2 months, what does this time have to do? Is it important to buy time? Yes, of course. From the buyer's perspective, right? If they can have this $300,000, if they can being able to use the use of $300,000 for 60 days or 2 months can mean a profit of something, or the opportunity for profit or not, right? For example, suppose the maturity of the promissory note is 90 days. What does that mean? They can Best Buy can use this money, $300,000 for 90 days, and they can put it into some stocks, right? That has expected return of 10%, right? And then they put it in the that stock for 3 months. And 10%, usually, as I've been telling you, all the returns are always, quoted as annual. So normally if I say, it has expected return of 10%, it means, annually 10%. But we can adjust it for 90 days, because it's simply 90 over, you multiply that, 10% by 90 over 360, right? Or 365. But let's say that 10% is for 3 months, for holding 10% holding period return. So then 10% of 300,000 is 30,000. So so Best Buy can make return of 10% for 3 months, and then when this promissory note comes in for clearing, they can pay 300,000 at the time, and during in the meantime they can have the use of that 300K, and then they can benefit from it, right? So buyers prefer to pay with promissory notes, but it's the opposite. If you're the seller, in the seller's position, right, in the seller's standing point, from seller's standing point, it's totally the opposite. Seller would prefer, most preferred modality of payment is cash, because cash is right away, instantaneously, they receive cash and they can put it into their bank account and earn interest for, already 3 months. I mean, why 3 months? If they receive promissory note, that's the interest they would forego, right? If they had received promissory notes, they would have foregone the interest for 3 months. But if they received cash, there is no such thing. There's no such opportunity loss, right? So cash is the most preferred. Then check, because check or credit card, pretty much check takes only 3 days, so they can put it instantaneously and earn, or they can put that 300,000. The seller can put 300,000 in the stock that earns 10%. But if they receive promissory note, they forego all that opportunity. And then a credit card, they get they get paid, I guess, if they it's the bank, the credit card company that will be the one. But the company will get, this seller will get paid instantaneously, right? Of course, they have to pay fee. So because they have to pay fee, seller would obviously, that would be number 3. I mean, check, number 2, and then number 3, credit card. Number 4, promissory note. Of course, the promissory note then obviously will be the least preferred payment modality from the seller's perspective, right? So promissory note, I already, in the main lecture, it was already explained, because it is the least preferred by the seller. The buyer pays some interest, at least like average market interest rate for the to facilitate, to make it easier, or to incentivize the seller to accept the promissory note. Okay, so if the going rate in the market is 3%, think about it, and let's say that's for 3 months. The buyer will, if the seller holds the promissory note for 3 months and then presents it, they will submit it to present it to the Best Buy, and then Best Buy will have to honor that because it's their promissory note they issued, and they will have to pay 3% interest on it. 3% of 30,000, 300,000, right? 3% is like 1% will be 1% of 300,000 is 3,000. 3% will be 9,000, right? It will be 9,000. But so they pay total of 309,000. But the Best Buy has used this fund, right? Use this 300K for 90 days and earn 10%. So still, even after they pay 3% interest on the promissory note, they will still make 7% out of this, right? So that's why promissory note is frequently used in business to business. But usually promissory notes are not held by the seller until maturity. I mean, they can do it until maturity, but most small businesses, if they are small business, I mean, Dell is not a small business. I mean, Dell is an industry giant, but even the giant corporations sometimes run into cash flow shortage, right? And small businesses are always tight with cash flow. They are always, short of cash flow. And tight cash flow means always, they are at risk of default. They can be at risk of default. I mean, this, the Chinese, real estate developer, Evergrande, is a giant corporation, but they were in the cash flow shortage. That's why, first of all, when you default, it's cash flow shortage made, right? You have, in other words, you have a lot of current liabilities. It's not the long-term debt. It's always the current liabilities that can put that can make even the giant corporations go bankrupt. So that's cash flow is always a very critical factor, right? So most companies do not hold accounts payable until maturity. They simply take it to the bank, right? Negotiate the sale of those promissory notes, and the bank will discount it. In other words, that's also called factoring. So think about it. The total so Dell takes this promissory note to the bank, and the the total maturity value of this promissory note is 309,000, right? 309,000, right, with 3% interest. And then, but they cannot get 309,000. They will get it discounted, right? Depending on when they take it to the bank. I mean, there are 90 days on this, 90 days on this promissory note. The maturity is 90 days. And then on day one, on the very same day they received it, they can take it to the bank. And with full 90 days left, right, it will get discounted. It can get discounted deeply. I mean, because the risk is being transferred. No bank will do it for free because they are taking over the risk. What is the risk here? The risk of not getting their money back. In other words, what if the issuer goes bad on their liability? I mean, that's possible. That can happen. Evergrande's, creditors, right? I mean, in this case, the bank will become the creditor, right? Because Best Buy sold, the Best Buy issued this promissory note to Dell. Dell sold this promissory note to the bank. So the bank is taking over the risk of the default. And in case the Best Buy defaults and doesn't honor this liability, 90 days later, right, then, the bank will sustain a huge loss, right? So it's only natural, because of that, risk, it's only natural that the bank discounts this, because they have to get something. They have to make something for taking over this risk. But if Dell takes the promissory note, sells this promissory note to the bank with 30 days left, right? Of course, that means Dell has been holding it for the first 60 days, and if they have already held it for the first 60 days, then it's more likely that they will continue to hold it until the maturity. But who knows? Anything can happen. So Best Buy, with 30 days left, right? If they take it to the bank, then they will discount it much less, because now the risk is only for 30 days, not for 90 days. So it will be discounted by much less, right? But the point is, the promissory note, in other words, is like a short-term debt. Promissory note is like a short-term debt, isn't that right? It's the debt that the seller gave the buyer, right? Deferred payment is a kind of debt, isn't it right? It's like credit card. I mean, you buy something with credit card. It's the debt, short-term debt, they gave you, the credit card company gave you, right? Deferred payment is a short-term debt the credit card company gave you for 30 days. Isn't that right? So it's just the same thing. Promissory note is a short-term debt. But when you think about the debt, the lender and borrower won't change. It's still the same lender, same borrower. You are the borrower, and the lender is the bank or the credit card company, the same bank, same credit card company. But in the financial market, promissory notes, the borrower, in other words, the issuer, is still the same. Issuer is Best Buy, but the borrower is the Best Buy, but the lender could be anybody, who is holding that promissory note, right? So initially the lender was the Dell, but then Dell transferred this debt, sold this debt to the bank. So the lender is now the bank, right? Let's call it Bank A. Now, the Bank A doesn't have to hold it to maturity. Bank A can sell it to another bank, Bank B, or Bank B can sell it to Bank C. I mean, this can go on any number of times, n number of times, right? Any number of times until, let's say from Bank A to Bank Z. And the Bank Z, right, Bank Z can be the final holder of this promissory note. And as the final promissory note holder, Bank Z will present it to Best Buy, and Best Buy will honor it. So it doesn't matter who is the lender. I mean, whoever presents the promissory note, right, will receive that maturity value. Okay. So that's what is interesting about the financial market, because assets are always changing hands. Assets are being traded, right? It changes hands, always, constantly, and whoever is holding that at maturity has the claim to it, right? And accounts receivable, I mean, promissory note is a kind of accounts receivable, isn't it, right? But why did I separate? Why are these separated as two line items? Accounts receivable are basically, credit sale initiated by the seller. Now, promissory note is a credit sale initiated by the buyer and imposed to the seller by the buyer. But the accounts receivable is credit sale initiated by the seller. Now we're out of time, right? So we'll have to stop here. So I'm calling it a day. I guess we can wrap it up on Thursday and move on to the next topic. All righty, so that's it for today. All righty. I will see you guys, on Thursday. Have a great.
Thank you. Have a good day, sir.
All righty, you too.
Have a good one.
All righty, you too. Have a great rest of the afternoon.
Same to you.
All righty. Okay, I'll stop sharing and stop recording and sign out.